Hi class, welcome to Chapter 10. We're going to talk about fixed income securities. We're going to go into a little more detail than what you have done in the past, but then it'll take us into Chapter 11 where we can talk about how to build bond portfolios. So some of this is going to be a review, obviously, but let's start off at the top. A bond is basically just a securitized loan, and by securitized, I mean it's been, a contract has been created, creating multiple bonds, right? So when a company wants to take out debt via a bond offering, what they'll do is they'll have $1,000 bonds, which are $1,000 loans, right? And they're going to work with their investment bank to sell each one. So if they want to raise $10,000 in debt via a bond offering, they have to sell 10 $1,000 bonds. Okay? And so it's securitized because they can trade, and one bond is pretty much exactly the same as another bond, right? So they're, to use some of the crypto terminology, they're fungible, right? One bond is the same as another bond, and so that allows them to sell them in the markets pretty easily. It's not like a one-off custom product. Coupon payments, those are the twice a year interest payments, right? So bonds are different than the consumer debt that you and I know. Consumer debt, typically what you do is you pay interest every month. Not only that, you pay interest plus a little bit of the principal, right, of the loan every month. So then at the end of the term of your consumer loan, you're done. It's fully paid off. Boom, right? But with a bond, you lend the money, you buy the bond, which is you're basically lending the money to the company. And what the company does, they've got the money. Now, twice a year, they have to make interest-only payments on that bond. Twice a year, interest only. And at the very end of the bond, they have to repay the principal. And that principal, it's got a couple different names, which is kind of strange, but face value, par value, face value or par value is used. It almost seems interchangeably, but that's the amount that's actually being borrowed. And that's how much the company has to pay back at the end of the loan. And you may wonder, why don't we have loans like that for, consumer loans? Well, a loan where at the very last day everything has to be paid back, it's kind of risky, right? And so I think if you look back at the history of consumer finance, a lot of people, people used to go to jail for not paying back loans. Think about, I think in the UK they had something called debtor's prison and stuff like that, right? And so I think that's one of the things that reduces the risk of borrowing money, is that you're kind of forced to pay it back a little bit every month, right? With a normal loan. The coupon rate is the same thing as the interest rate that's paid, and it's communicated as an annual interest rate, right? There's a term that's used with bonds. It's called a basis point. And a basis point is basically 0.01%. Okay? And the reason is because in some of the fixed income markets or bond markets, dealers will quote a markup. And a dealer buys a bond from a seller, and they'll find a buyer for it, and they have a markup in between. And so sometimes they'll quote their markup as kind of like a yield to maturity. And so the difference in the yield to maturity will change the price. So it kind of embeds the price differential there. And if you look at the fixed income markets, sometimes small changes in interest rates can have a big impact, especially on long-term bonds, if you remember. And so since small changes in interest rates can be significant, it's sometimes referred to, when there's an interest rate change, they refer to it as basis points. For example, if the Fed cuts interest rates 0.25%, right? 0.25% is 0.25%. 0.25% is going to be 25 basis points. If the Fed cuts interest rates a full 1%, a full 1% is 100 basis points, right? So it's just a finer way to describe interest rates that goes into a little bit more detail than you would with an interest rate change. When you hear the term premium bond, that just means the bond is selling for greater than its par value. And for us, that means it's selling for greater than $1,000. A discount bond sells for less than par value, and so it's selling for less than $1,000. Some bonds, from the very beginning, they will sell for less than $1,000 automatically. And let me give you an example. Treasury bills, right? Short-term treasury bills. Short-term treasury bills don't pay a coupon. They're kind of like a zero coupon fixed income, right? They last less than a year, and you basically buy that treasury bill for less than at par value, face value, and then at the end of at maturity, you will get full value, par value. And so the difference in value there from what you buy it at to what you get at the end is kind of your embedded interest, even though there are no interest payments. And so treasury bills are issued originally at a discount to the par value of a bond. Every bond issuance is like a security, has a contract, backing it up, and we call that contract a bond indenture. And that'll list things like whether or not the bond is secured or unsecured. By secured, I mean this is not the same as securitized. When I use the term securitized up here, that means it was turned into an issue where they could sell little pieces, right? Like a stock, a publicly traded stock. The equity is securitized by selling shares, right? What I mean here is the bond itself secured with collateral. Okay? And and a lot of company bonds are not secured by specific collateral or assets. Most of them are just go under the general liabilities of the company. But there are some loans out there, especially if you have kind of a risky business. Well, they will tie specific lending to some specific assets they're using the lended money to buy. Let me give you an example. If you take out a loan from your credit card, it's unsecured. All they have to do is they just have to go after you personally as a person to get the money. If you buy a car and take out a car loan, that car loan is secured by the car, right? So if you stop making payments, they can collect the car. And same thing like if you take out a mortgage. Home loan is secured by the real assets or the house itself. If you take out a personal or signature loan, it's unsecured. It doesn't mean that they can't seek recourse if you haven't made your payments. It just means they have to go after you kind of like in bankruptcy court or claims court or something, and they just have to duke it out with all the other creditors that you may owe money to. Convertibility, that basically means that a bond has the right to be converted from a bond, from a loan, into a certain number of shares of stock of equity. This feature is used when you have a risky company, and so investors might feel better if they own debt, if they lend the company money, because they know if this company goes bankrupt, right, and there are any assets left in the company, it's the debt holders who are in line first to get any monies that are left over in the event of bankruptcy. And so holding debt, especially senior debt, is advantageous if the company fails. But if the company does really well, your potential returns on holding debt are kind of capped at that coupon rate, right? And so having this convertibility feature entices investors to invest because, one, they're protected because they have debt, but they can convert the debt to shares of stock, and then they can take part in the tremendous growth if the company is successful. Some venture capital investments are structured like this. You could have callable debt, and they have this call feature, and that's basically where it gives the right of the issuing company to call up the people who bought the bonds and say, I'm buying back my bonds now, before the bonds become mature. It's kind of like, with consumer debt, you have the right to pay off your debt early. If you make enough extra payments, and then your loan has to be cleared. That's the way the laws are written. Bonds are not like that. Once a bond is sold, a company has to keep making those payments for as long as the bond lasts. If the company wants to pay off their debt, they'll have to hire, some bond traders, investment bank, to go out and start canvassing those bondholders and saying, hey, would you mind selling us your bond? I'd like to pay off my debt early. And a bondholder might be like, know what? I don't feel like it. And then the company's stuck. They can't do it. And so this call feature allows companies, it's written into the bond indenture, that if they decide to call in their loan, right, to pay it off early, they can do that. And companies often do that when, if the bond was issued when interest rates were very high. Think about, I don't know if you know much about, home loans. When interest rates drop, you may see in the news that people are refinancing their mortgages. And it's written in the law that you can take out a new loan at a lower interest rate to pay off your old loan at a higher interest rate. Well, companies wouldn't mind to have that option as well, and to be able to do that, they have to add this call feature. And the call feature will give them the right to pay off the bond early at a certain price. Usually it's above face value. The put provision actually gives a little kind of power to the bond investor, where the bond investor can put the bond back to the issuer, the company, and say, I want to be paid back early. It's kind of like calling in the loan early type of thing. And it's it's a little dangerous, but for the company if they have that feature, because what if they don't have the cash available, right? Sometimes bond indentures can have floating interest rates. Interest rates might be tied to like a short-term interest rate or something, and every year it gets gets reset, kind of a variable rate. The other thing is on bonds is that we have these. The way the prices are quoted on a bond is kind of unique. It's not like the stock market world, right? In the stock market world, if Nvidia is trading for $940 per share, you look up a stock quote, you call a stockbroker, you talk to your financial advisor, they'll tell you $940 per share. Bonds are a little bit different. Bonds are quoted as a percentage of par value. I don't have a good answer for you why this is, but just realize that, bond markets are a lot older than stock markets. And so, there's it goes back to history, and maybe it's just because easier, instead of quoting a price, $1,160, they will just say, 116%, 116. So you can kind of say the number faster. So like, let's say a bond is trading for $900. The price will be quoted at 90. If a bond is trading for par value at $1,000, it'll be quoted at 100. So it kind of lops off the last number. The other thing that's kind of unique to bonds is this accrued interest. And so we have to, the way it works is different than stocks, right? On a stock, some companies, they pay dividends every 3 months, 4 times a year, right? And if you buy the stock at a certain date, and then after the dividend X date, you will get those dividends. You get all of them. You don't have to share them with the person that sold them to you, right? It just depends on who owns the stock after a certain date. They get the whole dividend. Bonds don't work like that. With bonds, the interest being paid twice a year, every 6 months. And for bond investors, that interest payment is the whole reason for buying the bond. They're counting on that, right? So imagine if somewhere in between, 3 months after the last coupon payment, you sell the bond. But the company hasn't paid the interest on that yet. With the way bonds work, when you sell that bond, the buyer has to pay you now for those 3 months of interest that you're not going to get because you owned it while that interest was accruing, but it hasn't been paid yet. So we have this accrued interest thing that we have to calculate that takes into account how long the seller owned the stock during that 6 month period between interest payments. This is an older thing from Treasury Direct, their website. The newer page is a little harder to read, but the main thing here is you can see here we've got the security listed, 3-year, 9-year, and it shows like the type of security, a note, tips, notes, bonds. We talked about some of these back in the chapter, was it 2, right? Issue date, maturity date. Here's the interest rate is the coupon rate right here. The yield is the yield to maturity. And check out the price. It says 99.92. And up here it says per $100. So this is quoted as a percentage of par value. So it's 99.92% of $1,000. That's what that's the quote right there. And then QSIP is kind of like every security out there, publicly traded security, has a VIN, like a vehicle identification number, just like your car, that uniquely identifies it, and that's what QSIP is. All right, I'm gonna catch this slide on part B.